Today I want to continue our discussion that we've had in the last two videos about the dollar during a geopolitical crisis. And as we've seen in the last two videos, the dollar continued to go down, which we call an anomaly, during a geopolitical crisis. And the yield of our bonds actually didn't really decline until after the crisis. It's only for 5 or 6 basis points, all right? And it's because people believe the Fed is now going to cut, which we will see, all right? The inflation numbers on Friday. But there are other actions that are being taken by our government that are quite telling. So the first thing is that Besant on Friday asked the Congress to remove Section 899 from the big, beautiful bill. And the reason that I believe that Besant did that is they are terrified that foreign governments are not buying our bonds and, in fact, are selling our bond. And this is, I think, reflective in, one, the dollar is down, and two, our bonds, the yield has gone up from 350 to 440, now we're 425, 426, somewhere in there, right? Certainly not down. And the amazing thing to me, if you look at it, the euro's up over 10%, the Swiss franc's up over 10%, the yen's up about 6%. We're down 10%, right? But we have the highest interest rates. It should be exactly the opposite, but it's not. And it's a fact. So we have to deal with the fact that this is what's happening. Now, the second thing that happened this week was the SLR, the supplemental leverage ratio, which we put in, the Fed put in after the great financial crisis for our big banks, our G-SIBs, our globally systemic important banks. We have 8 of them. We had 9, but now there's 8. Now, these 8 banks have a special capital requirement that they had to keep since the great financial crisis. Now, last year, we've done multiple videos on this. The big banks sent to the OCC, the FDIC, and the Federal Reserve that, listen, if you keep this SLR, we're not even going to participate in the auction. Now, I have a different opinion of how I would have handled that with the banks, but the Federal Reserve on Friday said, you know what, we're going to get rid of the SLR, right? Now, they're doing this because the banks say this is the way that we can buy more treasuries on the offering. And frankly, I think it's not the truth. Here's the Invesco banking ETF. Now, they have a lot of the big banks, but it has medium-sized and small in there too, okay? But my point being is, look at this chart, right? So this narrative that we have to get rid of the SLR so we can have more liquidity to buy treasuries is total BS, all right? These banks are going up not because they can buy more treasuries, it's because it's going to give them more capital, which they can then invest. And remember something, so if you see that this will save $500 billion or $700 billion for JP Morgan, multiply that times 15, 20 times. That's how much money. It's a lot of money. And guess what? They're throwing it into the market. And here's JP Morgan's chart. And look, it's going straight up. It's not going because they can buy more treasuries. It's going up because they now have a lot more capital that they can leverage up and throw into the markets. So we have to be careful when we're watching what the Fed is doing, what the Treasury is doing, and try to read into it realistically, okay? We know that people are selling the dollar. And in fact, is today in Yahoo Finance, a economist at Harvard, Rogoff, he came out and said, hey, America, be prepared. You're going to have interest rates going to be higher for a very, very long time. Anybody who follows this channel knows when we talk about inflation, our watchwords are higher for longer. So same effect, interest rates, inflation. And here he says, look, This is because the role of the dollar is shifting, and the consequences for interest rates in the American economy are going to be long-lasting. And he also points out in the last sentence here is that the Asians are actually moving away from the dollar. And what I would say about that is the Asians are about half of the dollar holding. Now, this Rogoff believes that we're accelerating, but it's going to be a long time. Look what he says here. Asia is half the dollar block. And China probably should have decoupled a long time ago, but now it's happening. And so, coupled with the U.S. fiscal strain and the political pressure on the Fed, you're likely to see real interest rates elevated far longer than most Americans are anticipating. Now he points out here that the dollar doesn't mean to be replaced overnight. We've been saying this. It's minimum 5 to 10 years, okay? Because of TINA. There is no alternative. So it's going to take time. We had years where over 70 cents of every investable currency in the world was invested in the United States. And what we've been saying is they can't go to zero. They can't cut it by 50%. But do they go from like 74 last year to 65 this year and then 60? Even that is putting pressure, and we're seeing that. The dollar is down even though we have the highest interest rates. And now he's comparing this to the 70s when President Nixon ended the dollar's convertibility to gold, prompting the European countries to move away from the U.S. currency. What does he mean by that? Well, everyone had their individual currencies in Europe until we went off in the 1970s. So when we did this, our Federal Reserve and Treasury went around and twisted arms around the world, and including every country in Europe. And the Europeans realized after they lost and it was no longer convertible to gold, that, hey, we need to protect ourselves. We need to pull ourselves together. And they created the euro. And so we lost Europe, and it never came back. So where's the dollar now? It's in Asia, but it may not stay that way. And one of the things Rogoff believes is going to put huge pressure on the dollar is what's going on between the executive branch and the Fed. And this is not good because I would say countries don't trust our executive branch as much as they trust the Fed, right? And now that is also going to go away. And by the way, in the Marin Papers, they openly state that they want to take over the Federal Reserve, put it under the Treasury so they can lower the interest rates, even if it, quote unquote, artificially, so that they can then turn around and then swap our 10-year bonds into 100-year zero coupon bonds. That's all in the Marin Papers. And Rogoff's message means that the dollar isn't disappearing. We have enormous strength, but ignoring these shifts would be a mistake. And then down at the bottom, his last sentence is, Trump has been an accelerant of trends that are already happening, but the fundamentals are in place no matter who won the election. So as we pointed out in our last video, that even though we have the highest interest rates basically with the competing currencies in our space, the dollar's down now 11%. And other currencies are moving up. And this is going to force our interest rates to be higher for longer. And the dollar selling is going to continue for 5 to 7 years. The issue that we're facing is down currencies normally are highly inflationary to that country. That's us, okay? And so we believe that we're in an inflationary environment. We believe we're in a 3-wave inflationary environment. We believe we had 1 wave, and now we're getting ready to start the second wave. And if you want to know, the second wave is usually 2 to 3 times higher than the first wave, and the third wave is even higher than the second wave. So we're facing an inflationary wave if and when our fiscal deficit is out of control, and secondly, the dollar continues to go down and we have no one buying the dollar or buying our treasuries. So whether we do SLR or which is meaningless, I think this is where we're faced. What do you think? Like and follow.